Hi, Eric. How are you?
Morning, Adam. Good. How you doing?
Good, good. Why don't you give us an update? We all know that you're in Santa Monica. I kept confusing you as being in Malibu, and thank God you're not there. What's the story in Santa Monica? Do the Santa Ana winds blow in your direction, or they don't go there?
Yeah, so the winds died down yesterday, but they're supposed to come back today and through Wednesday, which is kind of the worry. Both the Palisades fire, which is just north of me, which is like a very high net worth area and close to Malibu, as well as the East fire in Altadena and Pasadena, are both going on. They're like 10 to 15% contained, so the
Right.
worry is the winds carry them further. But it's like more than 10,000 homes destroyed, thousands of structures, businesses, especially in the East Fire,
Yeah.
which is, as you can imagine, more of an urban area. It's basically an outskirt of Pasadena.
Right.
Um, for context, there's only about 10 to 15,000 building permits for homes issued in LA each year. So it's basically a year's worth of residential permits
Wow.
wiped out already. So
Yeah.
there's going to be a lot of follow through with
How
property
did
insurers and whatever. Go ahead.
how did you dodge the bullet so far in Santa Monica?
Yeah, Santa Monica's been okay. The air quality's been pretty rough at times. It's
Mhm.
okay right now, but a lot of debris and ash.
Mhm.
But the fire just didn't jump into Santa Monica.
Yeah.
It went north into Malibu. So
Yeah.
all good here for now.
When you turn your faucet on, the water's there, the pressure's there.
Yeah, the water's okay. We still have power here, but the
Mhm.
rest of LA
Okay.
is not so lucky.
Well, we feel for everybody in California that's suffering, and I hope you stay safe and make sure you stay safe. You can always get on a plane and move in with us. We got some room, and our four dogs would love to play with Yo-Yo. So, anyways, this is actually an interesting time of the year for us. All of a sudden, I go on LinkedIn and I see everybody congratulating me for being in business for 18 years. So, um, Eric, you've been with us. I guess in May you'll be with us a year. So we've been around. We're old timers here. 18 years is pretty good for a financial services firm, and with your help and others, we'll carry it on. Um, what shall we talk about, Eric? Because there's nothing interesting to talk about. I guess I could ask Max, but I don't want to disturb him. I suppose Friday was an interesting day. Were you surprised by the strength of the were we surprised by the strength of the employment numbers?
No, I mean, 256 or 256,000 is definitely more than even some of the most bullish forecasts. But I think broadly it makes sense. It's squared with a lot of other labor market indicators. And then on a more technical front, we had the late Thanksgiving holiday. So some of that hiring showed up in December as opposed to November. But
Yeah, I think it was retailers, right? I mean, we had a
yeah,
decline of retail employment by a few thousand in by several thousand in November, and now
mhm.
we more than reversed that in December. So what was I think when we took the average for the past 3 months, which is increasingly the way to look at it, given the volatility of the numbers, it kind of looked like 170, 180,000 on average over the last 3 months of last year, and that's kind of consistent with what we saw before the pandemic. So the numbers looked absolutely fine to us, and that's why we wrote a piece for this morning called "The Recession is Over Again," because a lot of people were thinking that there'd be a recession over the well since March of 2022 to September of to August of 2024, there was a lot of concern there'd be a recession because of the tightening of monetary policy. But now that kind of disappeared. But what didn't disappear is the idea that there could be long and variable lags, that the unemployment rate might rise, and so the Fed had to lower interest rates several times to stimulate the economy to avoid a recession. So we sort of like in a revolving door. We got rid of one recession only to worry about a recession from long variable lags. And I think Friday's employment report kind of blows that notion out of the water pretty decisively. So the economy is doing well, and I guess now the jitters are on the inflation front. You've done some work on what the CPI and PPI might look like up ahead and what that implies for the PCED.
Yeah, so we get CPI and PPI tomorrow on the same day. Those obviously follow through into the PCED, the Fed's preferred gauge. So we're expecting a hotter CPI. Markets broadly are. PPI might be a little hotter as well. The interesting part is core services, and both Governor Waller and Chair Powell have now stripped out part of core services. So they have this like non-market core services. They're kind of running out of things to remove. But super core CPI was 4.1.
Did you mean non-market or market? In other words, they stripped out the non-market. They're not using that. Is that correct?
Yeah. I think one of the things they're stripping out is like financial services imputed payments, which like kind of go up along with the stock market. So naturally, you want to take that out because it's been raising PPI. But these will both follow through to PCED. I think the risk is, Powell's been talking a lot about the 3-month and the 6-month annualized rates. If we get a really hot CPI and PPI tomorrow, we might be looking at closer to 3% on those 3-month and 6-month bases, which I think would be definitely a worry for the Fed and squares a lot with more of the hawk talk we've been hearing from officials recently.
And then we wouldn't be surprised if we revisit 5%. I think we would be
Yeah.
surprised if we get much higher than that because I think at 5% we saw last time you attract a tremendous amount of buying, and I think that could very well be the case this time around. But so so far so good on our correction call. We were a little bit ahead of the pack and even ahead of the bond vigilantes back in August of last year when we said that be ready to, should you, we put a question mark on it because we weren't completely sure, but we said, should you be ready to sell bonds, short bonds? And turned out that was a little early, but September 16th, right before the Fed lowered interest rates on September 18th, I think we're down to about 3.65. Now we're at 4.75 or so. So it's been pretty nasty in the bond market for now, but we're still sticking with the idea that we're kind of back to normal. That this is where the bond yield should be, 4.5% plus minus 25 basis points. Could it jump to 5% short term? It could, but we think that kind of is a buying opportunity. And then in December, we concluded that the valuations were high, and the what was really high was bullishness. And we pointed out that there's just too many bulls. And so we thought there might be a correction early in January that could be exacerbated by tax loss selling. We felt that a lot of people were holding off on taking their capital gains to offset their losses at the end of last year. And I guess fewer and fewer people have losses, so they had a lot of gains. And if they wanted to kind of rebalance, maybe they had too much in Apple, too much in Nvidia, too much in the stock market. They might have wanted to rebalance, so they might have held off until January and weren't in any particular rush to rebalance. But of course, if the market goes down, that causes people to think that, well, maybe I shouldn't have waited to rebalance. Let's just do it. And so that could exacerbate the situation. So we think we could get a correction out of this in the S&P 500, something like 10%, but we're not talking about 15 to 20% at this point. Nor are we talking about a bear market because we're not talking about a recession. We don't see a recession coming at this time. So with that, Eric, any other thoughts before we go to the charts?
No, let's go for it. It is kind of funny seeing some of the talk now that yields are back at 5% or close there. People talking about, yields are going to 6 and 7%, which is exactly what they said in October 2023. And lo and behold, they fell pretty dramatically.
Well, I guess we tend to look more at sentiment in the stock market, but I think we should look at sentiment in the bond market, and it's pretty bearish now. And as you said, once you get to this level, you start talking about 5%, and then you start worrying about 6 or 7%. we don't think that's where it's going. But I mean, on a short-term basis, we might have a hot CPI, PPI. Eric, did the Federal Reserve Bank of New York's survey come out yet for December for the inflationary expectations?
I think it just came out like 10
Okay,
minutes ago.
I didn't see it, but the important thing is it's for December. The number that spooked the market on Friday, in addition to payrolls, is the consumer sentiment survey came out for the first couple of weeks of January. They do it every 2 weeks, and so they have the first 2 weeks of January, and there was a small spike in the 1 year expectations to up to 3.3%, an even smaller spike up to 3.3% for the 5 year outlook. And everybody's attributing it to concerns about tariffs and the inflationary consequences of tariffs. That makes perfectly good sense, but there's also a recognition, I think, that a one-shot pickup in tariffs would probably have just a one-shot uh, impact on prices. But as Eric and I have pointed out, a lot of the good news on inflation has been on in goods, durables and non-durables. Particularly durable goods inflation has turned into deflation. And so now if we have just a little bit of inflation in durables and non-durables and services remain sticky, then the Fed has a problem, and the Fed has a credibility problem, because then the bond market, the bond vigilantes' conclusion since September 18th that the Fed really shouldn't be easing, shouldn't be stimulating an economy uh, that's quite stimulated already, quite hot already, might be a mistake. But look, on the other hand, we don't want to exaggerate the strength of those Friday numbers. They certainly support our long-held view that the economy is resilient. But even we are cognizant of seasonal factors and some of the issues that relate to the data. And all in all, our conclusion is the economy is resilient, but it's not super hot. Anyways, let me just start off with a couple of the charts here. This is just the 2 year and the 10 year yield, and our point that we made several times when the Fed, when short-term rates were going up and long-term rates were going up in 2022 and 2023, is that sure, that reflected the tightening of the Fed policy, but it also reflected some normalization in the bond market. The bonds had been rigged this entire period since the great financial crisis. They weren't. There wasn't really a market. The Fed, through QE, quantitative easing, basically kept the rates extremely low, in addition to having a Fed funds rate at zero. But now that the bond vigilantes, the bond market, the bond investors have been liberated from that kind of tight control, you can see that it's kind of back to where we were in this period before the great financial crisis. So again, we think we've been using the word normal a lot. The bond market's normalized. The employment labor market is normalized. This is what we and lots of other people have recognized, that something's amiss here with the Fed lowering rates by 100 basis points. And over the same period, this is the first rate cut on September 18th, the bond yield going up over 100 basis points, the 2 year going up by a little less than 100 basis points. The markets, now that they're kind of liberated to express an opinion, were of the opinion that the Fed is making a mistake in easing, and that interest rates weren't too restrictive at this level, and they're certainly not restrictive at this level. And then, in addition, the more, well, we had Scott Bessent was named to be U.S. Treasury Secretary, and that was good for a little bit of a rally. But now the market's focusing on Trump 2.0 and all the different moving parts that there are there, and kind of questioning whether a lot of progress can be made on the deficit. And as you know, Elon Musk just last week confessed that, acknowledged that cutting $2 trillion out of the deficit is not a realistic goal, certainly not on a 1 year basis, maybe not even on a 4 year basis. On a 10 year basis, yeah, it's $200 billion per year. But we got to we have a ways here before the incoming administration demonstrates to the bond vigilantes that they really care about them and that they really intend to keep do something about lowering the deficit. I think we're sort of in a Clinton-esque moment here for Trump in the sense that Clinton was told by Robert Rubin and James Carville, that he couldn't, that he had to have disciplined fiscal policy and actually narrow the deficit, or else the bond vigilantes would come and get and bite them. And so I think Trump needs to have Bessent and maybe a few others tell him that as well. If Trump starts railing about the Fed needs to cut interest rates, that's not going to be very productive. That's going to be a mess. But maybe Trump has learned something from Trump 1.0. Maybe Trump 2.0 will be different in a more positive way, at least with regards to the Fed. This is just a chart that Eric and I concocted showing how many rate cuts of 25 basis points the markets are expecting. And as you can see, over the next 6 months, they're basically expecting none. And then over the next 12 months, they're expecting basically one. So obviously, they were expecting a lot more back here, but that's when the Fed started cutting by 50 basis points and signaling that there were many more cuts coming. And we pushed against it. And we said that we didn't agree with it. We kept looking at the bond market and saying the bond vigilantes, our good friends, the bond vigilantes, seem to concur. This is the stock market. So we are having a correction here, in our opinion. Right now, it's a pullback. Pullback is something between down 5 and 10%. So we're not in a correction territory yet, but it's conceivable we'll get there in the next couple of months. We think the first half of the year will be kind of the choppier part of the year versus the second half. This shows that what the market's been getting now, where this is the equal weighted S&P 500. It's down more and closer to its 200-day moving average than is the S&P 500 on a market cap weighted basis. This is the NASDAQ. We still think this channel is relevant for where we're heading. So we thought that we'd get to 2,200 by the middle of this year, and we still think that's possible, but there could be a correction here. But you have to say, it's hard to get the NASDAQ down, because it might be hard to get the Magnificent Seven down, because all they have to do is mention something about AI or quantum computing and the stocks go up. Something to keep in mind. Russell looks like it's topped here, did not break out to a new high. And in an environment where interest rates are going to stay higher for longer, we prefer calling it normal for longer, the Russell could very well stay under some pressure here. So we're not big fans of SMID caps, the market broadening into SMID caps, partly because the earnings story just doesn't look all that compelling. And something like 35% of the Russell companies don't earn anything. They lose money. This is just since the elections. We had a good period of animal spirits here. Now it's kind of back to reality. We still think that animal spirits are working in the economy, and we see it in the National Federation of Independent Business and other areas. But the stock market is back to kind of, all right, let's see what Trump 2.0 actually looks like before we decide where we want to go from here. The good news, as I mentioned, is the bull-bear ratios have come down. So sentiment kind of reversed really quickly here, which is a positive development from a contrarian perspective. The other positive, Eric, you want to tell us what we're seeing here on the earnings season upcoming?
Yeah. So analysts expect 8.2% year over year earnings growth for Q4. We have the big banks kicking off at the end of this week, but growth has been strong, surprisingly strong, and so we're expecting a number more like 10%. So even if you get some valuation impact from higher yields, we'll get strong earnings growth, hopefully and likely to counterbalance that.
Yeah, and as you can see, this is the fourth quarter growth rate on a year-over-year basis, consensus expected by the analysts. So they're up there in the double digits areas. And then I guess with third quarter guidance, and as they're approaching fourth quarter, as they approach a quarter, they typically get a little bit more realistic. Maybe the losers tell them, don't be surprised if we don't meet your expectations. And so they start to factor that in. On the other hand, the companies that are doing really well, maybe they don't want to get the word out because they'd like to get the maximum positive impact on their stock. So if they got really good news, they're going to maybe hold on to it. So for whatever reason, there seems to be a fairly regular uh, statistical, there's a statistical regularity where coming into an earnings season right before it, you see that downward revisions. We saw that in the previous quarters, as you can see here for the year. And then we have what we call these earnings hooks, where as the blended numbers start developing, and finally you get the actual result, the result is better than what was expected at the beginning of the earnings season. So expected 8.2%, and we think it could be maybe at least 10%. Let's see how the banks report this week. Later this week, we think they'll report fine. Eric, just give us a quick update on this chart, which we kind of basically just discussed.
Yeah, so this is like the 3-month average of monthly payroll growth. And a couple months ago, we said, we're expecting the November, December, January 3-month period to be about 200,000. Looks like we're heading that way. We had the very weak October number due to strikes and extreme weather. And then we had 200,000 plus over the past 2 months. So January could very easily be another solid month, but 170, 180,000, that's pre-pandemic averages. That's what you want to see in like a slowing nominal wage growth kind of world.
Okay. Aggregate weekly hours, all-time record high. So that's good news. That reflects how many people are working and how many hours they're working. Then we calculate our earned income proxy using aggregate hours worked, simply multiplying by average hourly earnings by wages. And that gets us the wages and salaries component, a proxy for the private wages and salaries component of personal income, which then in turn gives us kind of a heads up on what might happen to retail sales, core retail sales, personal consumption expenditures of goods. And it all looks like they should be up solidly in December, because the December earned income proxy was up 0.5%, which beats the inflation rate, we think. Figure 14 is just shows that when you take average hourly earnings for all workers, for highly paid workers, and for production and non-supervisory workers, who, by the way, account for about 80% of the labor force, we've been in an upward trend here since the mid 1990s. Real wages have been increasing. During the pandemic, there was a slight spurt here, and then we saw that wages did not rise as fast as prices, but now we're back to that trend line. And so real wages are growing, and that trend line is about 1.8% at an annual rate, which is a pretty good way to see that real purchasing power, therefore the standard of living, is increasing, and it's a reasonably good monthly indicator of whether productivity is growing. And productivity clearly is growing according to that indicator and according to the actual data. Eric, so what's the only thing that is it kind of caught our eye is not that happy a situation for young kids coming out of college trying to get a job?
Yeah, so it was mostly a good labor report, and we saw fewer employed workers losing their jobs. We saw fewer people working part-time for economic reasons. They couldn't find a full-time job. This chart is definitely a negative. It is taking much longer to find a job if you're already unemployed. This can also be thought of as like the unemployed to unemployed labor flow. So it's a softer hiring environment, but we are seeing a number of signs that hiring will increase, whether it's the NFIB small business survey or job openings rising in JOLT. So hopefully this falls, but for now it's not great.
Yeah. And finally, the Biden administration, notwithstanding the president's infirmities, has been very busy for the past 4 years with all kinds of legislation and executive orders. We're just not sure who actually came up with them. We know who signed them, but we don't know whether the president knew what he was signing. I don't think I'm saying anything out of order here. I mean, this is just common knowledge now. But they're busy, and their latest busy activity is to slapped some sanctions on 150 oil tankers that the Russians have been using to get their oil into the world markets. And that's kind of the raises the question is like, why now? And the answer obviously is, especially as the elections were approaching, they didn't want oil prices to go up. So apparently they didn't mind that the Russians were sneaking some oil into the global markets. Now all of a sudden they care. And so that's had an upside impact on oil prices. Um, one fellow in the administration apparently said, "Well, we're giving Trump some leverage with the Russians so that if they want a peace deal, he can negotiate them to get those tankers selling oil again." That's kind of bogus, but that was actually said by somebody. Uh, but this creates a little inflation problem short term. Going into the next few months, we could have gasoline prices back up. Now, of course, there'll be an executive order from Trump uh, announcing that the incoming administration will be selling lots of leases. If the leases happen to be for oil and gas that are easily accessible and don't cost a lot, in other words, the cost of production is relatively low, and that could help to bring oil prices back down. Eric, I'll stop sharing. Why don't we start sharing about our accounts questions? Let me turn that off. Go ahead, Eric.
So I'll bounce around here. This one's from Vincenzo. I've seen reports that when the PE of the S&P 500 is very high, it means nothing for the year ahead, but it's associated with very poor returns for the following 10 years.
Yeah.
And I think this chart was in the Howard Marks thing.
Yeah, Howard Marks, and I think also Goldman Sachs,
Yeah.
opened up that can of worms by saying that when valuations are high 10 years down the road, you're lucky if you're going to get 3%. You're not going to get 11%. The history of the S&P 500 says that 11% total return is a fairly dependable trend, but obviously you're not always there. And I guess 10 years from now you could be down to 3%. I mean, it's conceivable. Obviously, it's a forecast that doesn't expect earnings to do much to the upside, and we think that we're still in the early phases of a productivity boom where profit margins go up. So we wouldn't discount that earnings go up. I think Goldman also had a issue with concentration, and we're assuming that the Magnificent Seven are here to stay. They're not going away. They're going to continue to account for 30% of the S&P 500 market cap and have a 30 multiple. So, without them, I think I guess after this correction, maybe we're down to back to 19, maybe 18 and a half, which isn't crazy if you agree with us that every company is a tech company. You either make tech or you use tech to increase your productivity. And so it's just a different view of the future. And, I think altogether you can get basically 10 cycles and over the 2 cycles on a 10-year basis, looking at what historically is available for the PE. And it's not wrong. I mean, it kind of makes sense. But you can also have a situation where you have a bear market and somewhere in that 10-year period, the PE comes down and then you zoom right back up. So we're going to take it year by year. And I think a company like Goldman Sachs, if they sell the idea that you're not going to make much by buying stocks directly, then how about private equity? We got that for you. We got M&A, we got venture, we got all sorts of other products. Here at any research, all we've got to do is all we've got is our opinion. Go ahead, Eric.
I also think one thing with that chart is there's a lot of overlap because it's rolling. So like you're seeing the high valuation from 1997, 1998, 1999 lead to really bad returns over the following
Yeah.
10 years. It's like you kind of lose in a scatter plot the actual time series. So it's
Okay. And Howard Marks has a great track record, but I think he sells distressed credit. Is that correct?
yeah, he's in the business of preventing alternatives.
So he's basically saying, don't buy stocks, buy my distressed credit funds.
Okay, so this is an interesting one from Kevin and Eric. With the Trump administration for the next 4 years, if the U.S. wants to remain a leader as the economic growth engine, where do we see U.S. productivity growth coming from if like elevated inflation, higher interest rates, and tariffs are all concerns?
Well, I think, our roaring 2020 story has been something we've been pitching since 2019. We didn't anticipate that AI would, at the end of 2022, suddenly become the hottest technology idea around. And now all of a sudden we're seeing more talk about, or buzz at least about quantum computing. Um, I think we got supercomputers now. When you put all these NVIDIA chips together, it's basically supercomputers. Data centers are basically supercomputers. So we've been arguing that we've been in the digital revolution since the 1950s. IBM mainframes, then digital equipment, mini computers, then laptops, PCs, laptops, the cloud, and it's all about data processing. And the digital revolution is about processing as much data as you can, as fast as possible, as cheaply as possible. And I think AI has gotten to the point where somebody along the way said, you know what, we're processing so much data with so much potential to come to the conclusions that humans can't do it efficiently. Why don't we just create some large language models that'll help us do that? And that's going to be very relevant for autonomous driving, for humanoid robotics, for automation, generally speaking. So put that all together, and that's kind of what our view is. It's a technology-led productivity growth boom, and the growth boom right now is kind of back to normal from 0.5 to 2% annual productivity growth, and we think it's heading to 3.5 to 4%, which sounds delusional, but that's where we peaked in previous productivity growth cycles, and we have more going for this one than we had in the past. Eric, you want to take another one or two?
Sure. This one from David, I can quickly touch on. With no increase in the debt limit, how is the Treasury paying the bills? They have the Treasury General account at the Fed. There's like $600 billion there. And then they can use extraordinary measures, which are like weird accounting measures to continue funding the government. They can basically give IOUs to the Social Security Fund, whatever. There's probably like $1 trillion of spending power in there. So things are pretty much fine. I really wouldn't worry about it.
Then Janet Yellen said that January 15th, in 2 days, they'd be out. The whole thing would blow up.
Yeah, I think they're going to try extraordinary measures first, or at least that's what they said. But they ran down $200 billion of the TGA over the last 2 weeks. So, like, why did they do that? Probably to fund the Ukraine spending that they passed. But I think, like, if there's $600 billion sitting there for the Treasury to spend, we can worry about it when it's like $100 billion.
Eric, you want to take one more?
Sure. I guess there's a lot of questions about the fires. What are the potential impacts for labor and for inflation?
Well, you're
Our fire.
you're our man on the scene.
Yeah. So I guess, by and large, like 10,000 homes in a city of several million people is relatively small. The thing is that it's a large amount of homes relative to the new homes that are coming online. So you'll probably see rent increase. You'll probably see inflation for building materials, demand for labor. So yeah, maybe you get some short-term growth. On the other side of that, what a big story of this whole cycle has been the wealth effect, right? And having a lot of wealth in stock prices and home prices and feeling emboldened to spend, at least in the Palisades and Malibu, these are a lot of very high net worth people who either might leave LA or not, or have to retrench and no longer spend as much income as they were, after they buy a new home or whatever. So sure, rebuilding is good, but it's like, do you break a window to fix it to increase GDP? Because you could have used those resources more productive elsewhere. So by and large, net, it's a negative, but sure, there could be some short-term positives we see from it.
I think the other thing we've learned over the in recent years is this economy is absolutely huge, and it's had a lot of shocks in Florida and North Carolina, and this one obviously is bigger, but it's managed to absorb these shocks remarkably well, and that's our kind of working hypothesis right now is that we'll the economy will deal with this, and that California will come back for sure. But on the other hand, Eric is clear. This isn't over until it's over.
Yeah.
So we'll see how that goes. But look, we wish you, Eric, and all your fellow Californians safety and an end to this disaster soon. And we wish all of the rest of you a good week. And we think it could be a little bit on the volatile side, but we gave you a little warning about it, and now we'll look to see where we go from here and keep you posted on that. Thank you all for joining us.
Thanks, everyone.